Well, Vital is investing in growth markets. What we do is we turn critical challenges associated with water, food, healthcare, and sustainable infrastructure into opportunities which are high returns and create impact at scale. Our fund level theory of change is we use the power of successful businesses, successful and scalable businesses, to create positive change through the provision of these basic services: water, food, healthcare, and sustainable infrastructure. We've invested $400 million so far in equity. I'm happy to say we outperformed our industry, and not less important, achieving deep and transformative impact at scale. 22 million people gaining first-time access to essential needs: better healthcare, better food, better water, better education. If you are able to create companies and build companies that cater for these needs and provide these basic needs and services in a way which is affordable and accessible, you're in the right place. Now you ride the demographic tsunami. This for me is the opportunity in Africa, and this for me is how to tap this opportunity.
Nimrod, welcome to the show. I'd like to start by setting up a backdrop of your journey to becoming an impact investor in emerging markets. And specifically, you're investing in Africa. And I'd like to do this for people who don't know you. So could you please start at the beginning here? I'd like you to describe your childhood, which started out in Israel and in fact in Moshav, which I guess is sort of a cooperative agricultural community of individual farms. So tell me about that and what that was like. And I'd like you to also talk about your parents and maybe family discussions, all of this just to give us a little bit of color so we get a good idea from where you have come and your journey to impact investing.
Sure. Thanks for having me, Scott. It's a pleasure. Happy to share and remember myself, my history and upbringing. So indeed, I was born in Israel in a moshav. Moshav is a community of smallholder farmers. Each family has a plot, a private plot. In our family, only family members were working in our plot, in our farm, with very minimal paid labor and actually very minimal mechanization. So we didn't even have a tractor. Tasks were very repetitive. We were working long hours in, mundane, monotonous tasks. Thinning or pruning loquat trees, or picking avocado from the top of a ladder, or manual trimming or spraying trees. When you do these tasks, when your hands are doing these tasks, you either think or talk. And it's all determined by the distance between the trees that you and your family members are working on. So if it's nearby trees, you talk. And then if you go and work on a further away tree and you're by yourself, you think. That's a cycle. So you think, you have some time to talk, and then you think again. And my parents actually encouraged us to think and to think critically by ourselves. They were, reading books. They are book lovers, and they encouraged us. There were books everywhere, a huge library at home. So the natural conversations while doing these repetitive tasks were books and ideas. And my parents would encourage us to read difficult books. So they would say, this is a tough book, only very smart people could read it. So me and my brother would run and try to finish it and understand, even though it was beyond our reach. Same with the conversation and ideas. They wouldn't tell us what's correct. But so if, teenagers, we were like, we want freedom, another brick in the wall, so they wouldn't say, oh, this is how it should be. They would ask us, what do you mean? Okay, the system is not correct. So how do you think it should be? Do you have an alternative? Do you think it should be corrected from within the system or out of the system? So it never would be a lecture. It would always be encouraging us to think by ourselves. So my brother, grew and became a true science man, a research man. He's a top epidemiologist. And I leaned more to, experimental thinking, maybe philosophical abstract concept, but I'm sure we both came out from it all came out from this work. While doing this, we watched the family farm collapse economically. It wasn't sustainable. So small scale farming in Israel at the time wasn't sustainable. And it made us think and understand, that hard work alone is not enough. And maybe you are doing everything right, but the enabling environment cannot succeed within the environment or within the ecosystem. I think that taught us a lot and gave us a lot of food for thought for the future, again, about working within the system or the connection between what you do and what the ecosystem does and how does it support you.
It gave you a front row seat on an economics lesson. You mentioned that you didn't even have a tractor. Was that for economic reasons?
It was economic reasons. So our type of farm, which was mainly fruit trees, did not justify having a tractor. So we would once in a while, borrow a tractor from a neighbor and work with it, but it didn't justify having a family tractor. But most of the work was manually, however you look at it. So, even an automatic sprayer or any other agro tech that you can imagine, which makes total sense where you work in a bigger scale, just did not make economic sense when you're in smaller scale. And because of the structure of the moshav, each one for himself, basically, it didn't make a lot of sense for a family to buy all this mechanization unless it became, unless it actually lended or rented this and made this a business.
So these were all individually owned farms, and it was a cooperative of family farmers. And when you said that it collapsed, is that due to the agriculture industry becoming much more of a corporate farming effort and the advance of technology?
Part of it was because you cannot, as a smallholder farmer, what we have done, you cannot compete with larger commercial farms. So at the time, larger commercial farms started to aim for the same product. For example, avocados. It made more economic sense, and economy of scale was in their benefit. The other thing, so I don't know if it's technology. It's definitely when you have a larger scale, you can use technology. The other thing is that we were squeezed within a very tight section in the value chain. So for example, avocado is for exportation. You cannot export as a smallholder farmer. So you're totally dependent on an aggregator that buys it from you. So we would bring our avocado to a collection center and they would determine the price. You already took it, you don't have any other option. It's not for local consumption and you don't control the price and you have zero leverage in the negotiation.
What sort of primary schools did you go for that part of your education?
So it was local schools. I think there was schools somewhere in the background. I have to say it wasn't a major part.
Was it a priority?
Not a priority. We were doing okay. We were smart kids, but it wasn't a priority or something that apart from a very good teacher here and there that gave you education beyond the I think it added it added just a bit of value. Again, we were readers, so we both read from age of 13. We knew much more than school can give us in terms of how much knowledge. And it was local schools. It was okay. And again, the only notable thing is maybe one or two teachers that left an impression, gave you some really educational value. I would say more than technical knowledge.
So you completed your what we would call high school, and then did you go straight to Tel Aviv University?
So here, the most important factor that determines where you go when you're 18 is Israel. When you're 18, you go to your military service. It's obligatory. That's what you do. So we all went there. It's a melting pot. This is the channel where everyone goes in Israel. So that's where we went when we were 18. But as soon as I was released from my Israeli obligations and army, I knew exactly what I wanted to do, and it was not university. It was to travel the world. It was to see if what I read in the books is actually true out there, and how does the real world look like? How do people live? Is Joseph Conrad accurate when he described these rural far communities? And I wanted to see and experience that for myself. I just did that immediately when I was released, and I spent a lot of time living with communities, mainly rural communities. For example, I zigzagged across Africa from south to north, and I lived and I stationed myself for months in rural communities, living and working and ground level with the communities in Zambia, in Lake Tanganyika, in rural Tanzania, all across. And I would be for months at a time with the rural community and living life, helping in what I can, which was not much, but helping as much as I could and definitely experiencing firsthand the challenges.
We've got to back up here. You're in Israel, you were raised in this agricultural community, then you went to do your obligatory military service. And then how do you get from Israel to Africa? And then you said, I lived in rural communities, but that just doesn't happen. Tell me, how did you find these places where you live? And were you with any kind of a program, or this was just Nimrod's program?
Definitely Nimrod's program. It happens when you read too much. It happens when you spend so much time, I would say, in a confined place thinking. I think this is maybe that's that what brought him. How did it happen? It actually started in India. So I flew to India and I wanted to see stuff. I flew by myself with a Lonely Planet. I found out quite quickly that I'm less into attractions and I'm less into where a lot of people are, and I'm less into tourist traps. And one time I took a bus. It was raining very heavily. Okay, and where I waited for the next bus, it was no shelter. So I just walked to the first shelter I found, and there were a lot of cows there and domestic animals and an Indian family. And I found that I'm very, very curious. I mean, that was the first time I started enjoying my trip. I found that I'm very, very curious to see that this is how people actually live. So we have been there, this is how we lived, and this is how people actually lived here. And to my good surprise, I found that they're very curious about me as well. Communicating, understanding where I'm from, what I'm doing here. And that was maybe my first glimpse into, you can communicate directly with people. And if you stay enough, you actually get absorbed by the community. If you come with open heart and people see you for what you are, the community will host you. And in Africa, it happened many, many times, and I would stay within the communities, and people would invite me to stay, and I would stay. I would basically become a part of life.
So, are you traveling alone?
Alone. I was by myself. I was traveling by myself.
You started out in India, and then, of course, Africa is not right next door. What motivated you to go to Africa?
Africa was always in my heart, and I really found a lot of interest in Africa. From the bits and pieces you read and hear. And so I knew that I will go to Africa. It just was a matter of time. Once I discovered this real deep interest in community or how people actually live. So after a circle around that I did in Southeast Asia, I just took a plane and went directly to South Africa. And my idea was to cross the continent. So by myself with a backpack basically and a tent. And I did that for a long while. I did that for 3 years. 3 years I've done that. Once in a while I would join a program, but it would either be a local program arranged by a local government and I would come and help, or, Peace Corps. I found myself one time assisting with the fish pond in Mozambique, I think it was, if I'm not mistaken. So I would join small programs, but it wasn't that I was sent by a program. When I met NGOs and I could contribute, so I've done that as well, but it was always, I would say, an independent engagement with. So after 3 and something years of living with communities and helping, I thought that this is what I want to do. So this is what I want to do for the long term. So I want to live with communities. I want to be part. I want to contribute what I can but I thought it's just a long-term journey. So 3 years were not enough for me. And my idea was 99, I think, was what we call today digital nomads. Sure, no one called it by then digital nomad. So my idea was, you go back. The question was, how do I sustain such a way of living? You know. So my idea was, I'll be a digital nomad. I'll go. I'll learn how to code, and then I'll live here where I was staying. And once in a while, I'll go to the big city. I'll send a disc or whatever at the time was relevant to a company. They will send me back what is needed to be programmed. I will work by myself. So that was my idea. It was very far fetched and, in retrospect, not relevant, but that was what drove me to go to university. So I went to Israel and I went to study computer science. And while studying computer science, I had, of course, to study philosophy because I wanted to increase the level of books that I can read. I reached my limit by myself. So I studied computer science and philosophy. And computer science was great. I loved it. I found it very much a thing that I enjoyed doing. I excelled at it. But very soon, when we started looking at the market, when the graduates started looking at the market, it was very clear that my idea is totally, out of context. And on the other hand, the high-tech office life didn't appeal much to me. That's exactly where I, after graduating, I got a call from a friend saying that he needs some help in Angola. He has some projects there. So I jumped on a plane. I moved there, and that's where I met my wife, Sandra. That's 20 years ago. So we've been together 20 years. And that's also the point where my personal life and my professional life merged intertwined in a way that now it's always the two part. I find myself when people talk in conferences on the future of the continent as the future of my nephews, my 13 nephews and nieces that live in Africa. Most of our future generation is in Africa today. That's a very dominant, I would say, pillar both in my family life and in my professional life.
When you went to Angola, what were you doing?
In the beginning, we were doing some dull thing related to computer-based training, but very soon I found myself in agriculture. So in agri projects, doing all sorts of agricultural projects for a company involved in layers, broilers, dairy, crops, and then moving to agro industry, you name it, any kind of agriculture I was involved in. From agri, I moved to more agro industry. And when you work in these agro industrial projects or agri projects in the rural areas of Angola, you have to build the supporting infrastructure because there was none. So you find yourself water stations and energy solutions and roads. And since you're working with the community, you want to give solutions for the community. So you find yourself building a school and doing a lot of construction and building a clinic. So the scope went wider and wider. And myself, I went slowly from more operation related to managing related.
So you study computer science and philosophy, got some experiences in Angola, but you're known as a private equity investor investing in emerging markets and impact investing. So how did you get from this into private equity investing and impact investing?
After doing a lot of big projects and infrastructure projects, I started doing more and more management roles. I decided to back it by, MBA. You probably guessed that I've read all the books about management that there are, and then I decided to do an MBA. I've done an MBA in Israel, Tel Aviv Open University. While doing that and delivering and operating this project, a lot of thoughts on, are we doing the right thing here? Were occupying me. So, you build, you deliver. You build, you operate. And when you operate, you find that maybe you didn't build the exact thing that fits for purpose here. So I would say sustainability started being a very, very big pillar of what I want to do. But when you sell project or when you do EPC plus finance, it's very hard to change the specs because you think it's less sustainable and the client maybe is not aligned with you. Once I got the offer to join Vital. I found, I thought it's the right fit. So Vital, because of my background in working in Africa, infrastructure, and doing all these projects, they invited me to manage, upon Vital was, at inception. So it was 2010, 2011. I started managing the largest portfolio company of Vital, which dealt with urban infrastructure and housing project. I did that for a while as a CEO. Went very, very well, and I was gradually asked to be more involved in more activities of the fund. The board level, or just giving some consultancy. And in 2016 I was already doing only fund work on specific parts of the life cycle of investment. So I would do originating for a while, and then I would handle exits for a while, and then I would go and do value addition for specific portfolio companies. So I would do the life cycle, but not from A to Z, in parts. Wherever there was the biggest need for Vital, I would say, jumped in dealing with that. So I got a lot of experience in all the life cycle, from origination to exits across in different countries as well. And in 2019, I took over Vital Capital as managing partner. That's my journey to Vital. Took me to 28 African countries, and doing transaction in many of them. Also doing transactions and investments in India and in Latin America. And I would say Vital is the first time in this journey where I found that what you think and what you do can coexist in harmony, and it's where abstract concepts, where they meet reality. Sometimes they crash into it, and sometimes they harmonize with it.
You've kind of fast forwarded over some of the key experiences, I think, that prepared you to do what you're doing now. Around 2007, you were in a company called Agricultiva as the CEO. Explain what you were doing there.
This is part of experience in agro industry. It started as an EPC, so it's delivering projects, building farms, building the farm facility, building both commercial farms and agro-industrial facilities. So everything you can imagine, we have designed, built, and delivered there. If it's from feed mill to dairy factories to greenhouses and everything that is related to crops and aquaculture and layers and broilers. So it was very, very wide spectrum. And it started mainly with building farms and building projects, either to government clients or to private clients. But the idea is building farms, and then you operate them. So after building, in some of the agreements, we were operating the farms themselves, to bring them to profitability. It was mainly building from, most of the farms were built from scratch. And operation was defined by period. It was either through cooperating with the local farmers, but it was mainly through labor that was dedicated to the farm. The farms provided, and the projects provided, training and knowledge transfer. And I moved within this company. I managed the company, so I did both the operation, the design and build of the projects, and then the operation and maintenance, and in charge of the business development, which also took me to other places.
Is this a very large company?
Yes, it's a large company delivering large-scale agri projects.
I guess around 2011, you became CEO at Cora, which was a very large investment that Vital Capital had. What led you to leave Agricultiva and to move to Cora?
So through my work in Agricultiva, we have the spectrum of projects that we would provide grew and grew. Since the projects were set in communities, we would build solutions for the communities. So we would build the supporting infrastructure for these projects. So I found myself, even before Cora, building roads, building houses, building water treatment facilities, building wastewater treatment facilities, building energy solutions, all for the community, and building schools and building clinics and then operating them. And that's all part of what the projects provided to the communities. Okay, the projects provided to the community. So I gained a lot of experience in that, in everything which is construction and infrastructure. And Cora was urban infrastructure and affordable housing orientated. So I wouldn't say it was so far from what I've done. It was much bigger than what I've done, that's for sure. But it is still projects from scratch, design and build. So you come to a place where there's nothing, and when you finish, there is a big city there with tens of thousands of people living there, with the roads, with the water facility, with the wastewater facilities, with the energy, with schools, from kindergarten to technical high schools, with clinics and health centers. So the full solution for urban community from scratch. It was pretty much based on things that I've done before, but on a smaller scale. And Core was in a much bigger scale. It still required, design and build. It still required operation, and it still required a lot of work with the communities, because the families that move to these affordable housing, usually not urban dwellers before. So there's a lot of engagement with the community. By the way, from the moment that the first bulldozer go there, I think I exercised my understanding of how community works and what will the community think when they see a bulldozer here. So before anything appeared, we would appear and we would do, a full program of engagement with the community, so that they could become stakeholders and understand that this is going to benefit everyone. Yeah, it is big scale. And by the way, after that, we started building the supporting large scale utilities for these urban centers, the water captation and big treatment plants and big wastewater treatment plants and big energy projects.
These were all very large greenfield projects then. But you did not found this company, that you were recruited as the CEO, is that right?
Yes, yes.
And,
That company was founded by Vital Capital, and I was recruited as the CEO.
and Vital Capital had invested in Cora prior to you coming there, is that correct?
Yes, that's true. It's true that I haven't found it, but maybe I'll tell you where I came in the journey. It was more or less 5 engineers and a few plans on a table, right? So this is where I This is where I took position as the position of CEO of Vital, and when I finished there, we had thousands of people working in our projects, and as I said, actually more than 100,000 people living in the community. So it is an investment of Vital Capital, and they brought me in as the CEO.
And then in 2016, you joined Vital Capital, initially in an advisory capacity, right? But then in 2019, you became the managing director. So tell me how that all came about.
From 2011 to 2016, it was also gradual, because we managed to grow the company. It went well. And Vital asked me to be more involved in other investment and other activities that they have. So I took a board position in another company, and I gave them, I would say, some consultancy in the third company. I was a bit more exposed to what Vital does from the fund level, from my own territory as a CEO. And I really liked that. I really enjoyed that. And once we established Cora, and it really worked as a very well efficient machine, Vital asked me if I can work fully on Vital. So I joined actually Vital. I left my position as CEO and I joined Vital. And what I've been doing there is basically I was the resource that Vital dedicated to specific parts of the investment lifecycle where they had challenges and they thought that I could add value. At one time, I was doing a lot of origination, business development in Ghana and in Ivory Coast and in Kenya and in other places. Another time, I was working with their portfolio companies and adding value, either mentoring or working with the CEOs, or, doing it, strategic thinking with the portfolio management. Another time, I was dealing with preparing companies for exit. So I got between 2016 and 2019, I got exposed to the full life cycle of our fund work from the fund side, wearing the fund shirt. And there was a very long succession plan in Vital, which we all became aware of. At least I became aware of during this process that I'm in a succession plan. And in 2019, it was quite obvious. The next step was quite obvious, and I took over as the managing partner of Vital.
Let's just put a pin in this for a moment, because you had a long journey to agricultiva. That wasn't really impact, right? That was agriculture. Cora was technically impact, but it was a company you were running, and then you got into the fund. So at this point, everything's kind of coming together for you in terms of greenfield projects and investing for impact. So maybe this would be a good time for you to tell me, before we start to drill down, what impact investing means to you personally, and what's its connection to you and your family. And I think you have children. You've all lived together in Angola. I believe you now live in Cyprus, and your children speak 4 languages. Somehow I'm sure all of this gives you some unique perspective while working in a private equity fund in emerging markets, and drives what you are doing with your life.
That's exactly, where my personal life and my professional life merge. It's as I mentioned, my kids are, proud Africans. Grew up in Africa. My wife is Angolan, and they have me as a father. I came from Israel, more I would say Middle Eastern European orientation, and they have 2 very dominant identities there. They're very proud to be both. My nieces and nephews are spread all over the world. So we have a lot of family in Africa, family in Brazil, family in Portugal, family in the US, family in Israel, family in Cyprus. The questions which can be theoretical about equality of opportunities, or am I privileged? Is it bad to be privileged? Should I do something? Should I feel guilty about that? Should I do something about that? These are our dinner table conversation. My kids are driving that conversation, and they experience and lived, and their family is from such a wide spectrum, and they ask themselves as kids and now as teenagers these questions. And I also ask myself these questions, and I think impact investment for me personally is where I can show them rather than tell them what I think. For the question, is it bad to be privileged? Do I need to feel guilty? Do I need to do something about it? Can I do something about it? Should I do something about that? My answer is, look at what we do. That's my answer. I don't want to tell you the theory. I want to show you what can be done. I want to demonstrate that you can use the power of capital and businesses and create positive change. And here are a few examples. It is a very personal thing for me, and it's my way to answer these difficult questions that we all have.
Why don't we start with a high-level overview of Vital Capital? But let's start at the beginning with, what is its mission and your investing focus?
Vital is a high-performing investor in growth markets. What we do is we turn critical challenges associated with water, food, healthcare, and sustainable infrastructure into opportunities which are high returns and create impact at scale. So it's 4 themes, and the idea is to turn them into opportunities that create returns, financial returns to investors, and impact at scale. And the way we do it is through our operational expertise and experience. And this allows us to look at opportunities and work on opportunities that sometimes are unconventional or overlooked by other private equity investors. Our strategy is called We Build and Rebuild. So we build innovative businesses that are focused on operational capacities. We do a lot of greenfields. We do some special situation where it's involved assets which are operational assets. We invest through equity, taking controlling stakes. Some of these things are not very, super plain vanilla for a private equity investor, and I'll be happy to dive in. But we do take either controlling stakes or majority stakes. We've invested $400 million so far in equity, and we have, working through from 2011, so it's 14 years now almost. We have a very good track record both in terms of returns. I'm happy to say we outperformed our industry, and not less important, achieving deep and transformative impact at scale. So 22 million people gaining first time access to essential needs. Again, essential, first time access to water or healthcare, quality food, almost 65,000 jobs, working with 50,000 smallholder farmers. So the impact is transformative.
Excuse me for interrupting, but how many funds do you have?
It's a one continuous fund. It started as a closed-end fund, and then we opened it. So it's a open-ended, renewed through consent of investors. It's a one continuous fund. We do have, and we've done some facilities, but they're more specific for specific opportunities that come along the way. For example, in COVID, we have done a specific debt facility and other facilities, but the main flagship is this one fund.
And what's the total AUM that you have?
It's 400 million.
400 million? How would you describe your investors?
They are all interested in impact. They're all impact investors. Most of them have connection to emerging markets. They either work there or they have affiliation. Mainly family office and some high net worth. So I would say the typical investor is a family office impact investor.
And how many employees do you have?
Here it's also where Vital is not very traditional in the model. Vital roots and foundation and strong basis is a very big coalition of operating partners, okay? And supported by a lean, efficient investment team. The dedicated investment team is about 10. It's very lean and efficient, but it's not an investment. I would say the fund work is not an investment team looking for opportunities on the ground. It's basically the ground demands some investment support, investment professionals.
Before we drill down more, I want to discuss why Sub-Saharan Africa. Vital Capital's been recognized as an early mover in investing in Sub-Saharan Africa. I've seen you quoted as saying that Sub-Saharan Africa represents an immense and growing opportunity due to the region's increased stability, vast resources, rapid current and projected growth, ongoing urbanization, growing population, and emerging middle class. So maybe you can describe what is the opportunity there. And I'm asking this because there may be people listening who haven't thought much about investing in Africa as a concept, or people who've heard Africa referred to as a very difficult environment to operate in. So tell me specifically why Sub-Saharan Africa represents a solid investment opportunity.
This time I will use only one word: demography. So the opportunity, and by the way, the challenge itself is all derived from demography. Africa is going through what is called the Great Doubling. In 2050, 1 out of 4 people will be African living in Africa. 2.5 billion people will be African from a total population of 10. And it's happening quickly. It's happening, it's from 1.3 just a few years ago to 2.5. It's a huge demographic shift that is happening. And these populations are very young, so median 25, moving or becoming urban and becoming consumers, which is very, very interesting. So there's a growing middle class or consumer class that is inherent to this demographic shift. So if you look at from 350 million people, which are defined as potential consumers in 2010, to 1.1 billion people in 50 years in 2060. So, 3 times and hundreds of millions of people joining for the first time the consumer segment, which means that's the first time they have available money to spend. What do they spend on? The basic things: better healthcare, better food, better water, better education, and some better infrastructure. If you are able to create companies and build companies that cater for these needs and deliver, and provide these basic needs and services in a way which is affordable and accessible, you're in the right place. You're in the right place. Now you ride the demographic tsunami which is coming. So this for me is the opportunity in Africa, and this for me is how to tap this opportunity.
How do you compare it between the other emerging markets that people will certainly raise? What about India and what about Brazil? Of course, China is always there.
India is very interesting and is awesome. We also invest in India, but I think it's a very different market. I think you need very high level of specialization and to be very narrow in what you pursue, to be the best in one thing, and then you can win in India. There's a lot of competition there, and it's a different game. So I would say strategy to win in India, which is a very super interesting market. I agree with you. And the strategy to win in Africa is a bit different. I think the demographic change is happening only, this demographic tsunami is coming only in Africa. So this is the coming bigger player. This is where 700 or 800 million people will be joining now the consumer class. And you will be the one that can provide and sell them basic goods and services. I think India is very different. I'm not an expert in China, but I definitely see the potential in there. I also think it's a different kind of opportunity.
Of your 400 million of assets under management, could you just break down by region what percent of that is in Africa, what percent's in India? And I think you also invest in Latin America.
So today it's about 75 in Sub-Saharan Africa and 25 in others, mainly in India.
So really your big focus is Africa. That's probably what we'll be talking about today. And if I just understood your answer before, you have much more expertise and less competition in Africa than you run into perhaps in India and Latin America, correct?
That's true. I think there are other ways and other strategies to win in India, but that's maybe another conversation.
Another episode. Can you explain Vital Capital's theory of change and the problem or the problems that you're trying to solve?
I think the problem and the opportunity are quite related. The opportunity that I just described with this demographic change and the great doubling, the huge shift, there's no question that infrastructure and basic needs provided by central governments will not be enough. It is not enough today, and it will definitely not. The gap will just continue increasing. So this is the main problem and the main opportunity. Regarding theory of change, so our fund level theory of change is we use the power of successful businesses, successful and scalable businesses, to create positive change through the provision of these basic services: water, food, healthcare, and sustainable infrastructure. And we have a logic model that is mapping the pathway to these outcomes and long-term impact that we are trying to create. It takes you from the activities, building and investing in the companies, the outputs of what the companies, the scaling up of the companies, the outcomes of this company, which is better food, affordable healthcare, water, infra, and the trio: jobs, gender, and climate, which we'll be happy to talk later. And from there to the long-term impact, which is the improved well-being of the underserved community, directly connected to the SDGs. Now, this is the fund level theory of change. For each one of the themes, we have specific theory of change related to the investment model. So if I'll take food, for example, so the activity would be investing in smallholder farmers, in and with smallholder farmers. The outputs would be increase yield and income of these smallholder farmers. Continuing on this logic model, the outcomes will be better income or financial inclusion of these smallholder farmers, as well as availability of and affordability of improved food for local beneficiaries. And then again, the long-term impact will be directly connected to SDGs, poverty, hunger. In this case, in the food case, it's one SDGs 1, 2, and 9. So that's the theory of change, which is in the fund level and per each theme. And of course, based on that, we build the work plan and KPIs.
And the themes are basically food sector, health sector, and water and sustainable infrastructure. If you just at a high level divide your AUM between those four, is it equally, or are you heavily skewed towards one sector versus the other?
It changes. It's not always the same. So it's not that we have a specific inclination into one. I can say, other than healthcare, which we've done less, the other three are more or less equal.
Approximately, what is the ticket level that you're investing in? You say you take majority share, but what size tickets are we talking about?
Typical ticket would be $10 to $20 million.
Walk me through the end-to-end investment process that Vital Capital goes through. And maybe you can start by telling me, like, what type of companies is Vital investing in? And very quickly, that gets us to, how do you define your investment universe?
Remember that we both invest in and build companies. So we sometimes seed companies. We're looking for what everyone is looking for, good and capable people that solve a critical problem within our teams. They solve it in a way that someone will and can pay for. They have a viable business model. It can be scalable. For us, it's a good deal. And we look at the risk and we think that we can mitigate them in some way. And I would say the unspoken question we always ask ourselves is, can we really understand how it works? Bringing you back to our operational background, we really want to understand how it works. So in my imagination, I think, can I theoretically be the CEO of this company? Do I understand it well enough that tomorrow if I'm called, I can act as the CEO? And if my answer is yes, I could, and it's actually interesting, I feel comfortable and we feel comfortable to invest. And so this is the very strong operational lens. If we're talking about process, so that's general, of course. But if we're talking about process, we have a very methodic process, 4 stages with always 2 tracks, both the impact on one hand and the financial business on the other hand. The 4 gates, describing them quickly. First is, basic alignment, screening through exclusion list, seeing that the IRR financial exclusion list in impact and ESG and the IRR financial KPIs is more or less what we are expecting. It is done in a dual gatekeeper model, so the impact and ESG team and the financial team will work separately and will not discuss this opportunity yet. And both of them needs to give thumbs up for us to actually start discussing this opportunity. If any of them is hesitant, it never comes to the next stage. So only if 2 teams gave thumbs up, it comes to gate 2, where we do preliminary due diligence, what I call face value due diligence. Everything that is provided, we believe, and we take it for granted at face value. And we do, the team, we're looking at the team itself, the people, the founders, if we're seeding a company, business alignment with our themes through internal checklist and Vital and some proprietary tools like Vital Diamond. We look at the business model, we do the financial analysis, and in the end, it comes to a very big meeting, which I had as managing partner, and we all have to give thumbs up. And if we give thumbs up, it goes to the next stage, which is preparing to IC. Over there, we actually jump into much higher level due diligence. It's on the ground. Here, we're actually usually already working with the founding team and the company. Okay, so we're working them on what is the strategy and what is the business model. And we actually, even though we haven't invested in them yet, or the IC didn't see this company yet, we already work. We would take external due diligence where needed, where there's a big risk. We will do with them the initial, ESI plan, and this ends in 2 committees, 2 IC committees. So we have the traditional normal investment committee with us, with some internal members and with independent members. And at the same time, we have an impact committee with, again, internal and external members. So what started as dual gatekeepers, two internal teams working separately and then joining together, and we all work with the founding team, now I would say artificially separates again to two decision points. The investment team has to say yes, and the impact team has to say yes. And if the impact team, for example, or the investment team thinks it's not a good decision, it's not a good investment, we would not move on. From the first IC, what happens is pending issues, legal DD, which we haven't done, the commercial agreement, because sometimes what you understand when what is written is a bit different with the founding team. So we do this fine-tuning, finalization, and alignment with everyone, and that goes again to the double IC, to confirmation, and that's where we have a green light to invest.
If I've done my homework well, it seems that you invest in businesses at all stages of their life cycle, and you're not confined to only early stage investment, which is somewhat unusual. Does your investment process vary, if at all, from what you described based on the life cycle of the stage or the size of the company you're investing in?
That's an interesting question. I think today, or we learned, we evolved and we learned a lot of lessons throughout the years. We usually do want to join the company where there's something to build there. So in the past, yes, in early days, Vital did invest in a later stage company, and we're doing it less today. So I would say it is more concentrated on the early stage phase of the companies. It is different where you have a founding team and you actually build it with them, or if you come to an existing company. But not very often we find ourselves today dealing with mature companies investing in growth stage. We hardly do that. And I would say it's quite similar in the process. It is always working with the teams and with the founding teams on building the next stage or what will happen after we invest.
Just want to clarify, you described these investment committees, one's impact, one's finance. Is this iterative, or does it first start with financial return that you're only going to invest in a company that is going to meet your financial targets, and then you evaluate impact? Or would you be taking a deep dive on a company based on its high impact value, and look for a way to make it financially sound? Or is it one or the other first?
It is not one or the other first. It is simultaneously. It's basically done by two separate internal teams. When we get a potential deal, the impact and ESG team, they forget about the financials. They don't care if it's a bad deal or it's the best deal in terms of returns. They only care about, does that fit of what Vital is trying to do? Will that be scored high in our impact rating? This is what they care about. By the way, they might take something which is not advanced and they think they can create a great impact through that. Doesn't mean that the company is creating great impact today. Maybe the impact and ESG team thinks that they can bring it to a level which this company will make fantastic, scalable, transformative impact. But their consideration will be only that, even if it loses money. And they give green light only based on that, and they do not discuss this opportunity with the financial team. And the financial team is just the mirror, the opposite. They would only look on financials. They don't care if this company destroy Earth. You know what I'm saying?
Okay.
So they only look at financials. And if it's not a good business, and I don't think it's a good business, they will bring it down. They will not give thumbs up. If they think maybe it's not a great business today, but we can make it a good business, they will give thumbs up. Again, unrelated to what impact. So that's how we control it in the beginning simultaneously. There will never be a discussion, it's a great impact, can we make a business out of that? It's a great business, but can we decorate it with some impact elements? It's not It's not how we operate. And how we, I would say, double guarantee that is through these dual committees where you have external people, which mainly, independent members, which mainly care about their reputation. So if you have, a well-guarded impact professional as an independent member in the committee, he doesn't want to be involved in any investment. He or she doesn't want to be involved in any investment that is not impact. So they will stop it there. And same with the IC, they want to do good business. So this is how it's controlled from the beginning all the way to the IC.
And what is your target return?
20% IRR.
Okay, and your typical holding period?
So it started with 5 to 7, but we are trying to be more flexible, and our structure today allows us sometimes to be more flexible. Well, we learned that in our region to be very strict or play the PE timing sync game. You sometimes lose if you have so much money to deploy, and now you have two regional crises which come every few years, and you're deploying it because you have to, or now you have 1.5 year or 2 years to exit and you have to exit. You lose a lot of good opportunity. You leave a lot of money on the table and you're doing the wrong decision. Sometimes you just have to wait it out. And when you build companies, sometimes it goes quicker than you expected, and sometimes it goes a bit slower than you expected. So timing is a very crucial element.
How would you say your strategy differs from a traditional private equity strategy? Does the traditional private equity model work in the emerging markets that you are operating in?
I think if you look at data, it's quite clear that the traditional private equity is struggling in the markets that we work in. So results and returns are not very attractive. And further, I think that the traditional, playbook and framework of architecture of private equity is built on assumptions that do not exist in our markets. It's built on the ability to have access to credit. It's built on leverage. It's built on secondary markets. To say the least, these things hardly exist where we work. So you have to be much more creative, and you have to play with the same framework but with a different playbook. I wouldn't recommend coming with the old Western playbook and play private equity. It has been tried by all the many of the big funds. We had 10 years ago, I believe, 10 to 15, we had many private big names in the private equity space globally coming to Africa with a lot of promises, and most of them are not anymore there, with a lot of stories of failures created in the market. So yeah, I think you have to be very creative, and I think you have to adapt the model and how you work to the realities. Otherwise, it's hard to win.
All right, I want to talk a little bit now about how Vital Capital thinks about impact and its relationship with the financial returns. And you've just discussed this 4-stage impact assessment process.
It is built up from very basic screening to very, very deep due diligence throughout these 4 stages. And all this is before the IMM itself, before the investment. So we would definitely start with basically screening exclusion list and basically impact alignment, and we would be establishing we would try to see if the company has a clear impact thesis that is aligned with our themes and with SDGs. Later on, and this is the gradual thing that we do pre-investment, later on we would apply rating tools. One of them is Vital Impact Diamond, which helps us to screen as well. Once this is done around gate 3, we're already diving into ESG and impact deep due diligence, and we're building with the team the corrective action plan. Still before investment, we would already assign, the measurable impact KPIs, and this is all in gate 3. And in gate 4, we will already make sure that all these ESI clauses are integrated within the agreements with the company, within the documentation and agreements with the company. So So we set off when all this is already agreed. And now it is implementation monitoring.
So you've got this list of potential investments, and then you've just mentioned your Vital Impact Diamond tool, which I guess is a proprietary tool that you've developed. That's primarily used to assess whether these companies are investable from an impact perspective. What was the premise behind the Vital Impact Diamond tool, and how was it developed?
Yeah, it is. It is something that evolved. We started impact investing in 2011, and the impact investment industry was young, and definitions were blurred, and it evolved so much until today. And we try to be work within the industry, be involved in the industry, adopt all the tools that the industry offer. And when we think that we don't have a full fit, we also develop this as a proprietary tool that in the beginning only helped us to screen, and then we further evolved it to help us to monitor as well. So the Impact Diamond we started using it as a proprietary tool in 2015, and we have updated it, with the industry evolution. So we integrated into it other industry standard. So, we took into that a lot of wisdom from 2X Challenge and, IMP and, and Iris Plus and all the tools that the industry came up with, we have tested on our portfolio and adopted what is right. And the Vital Diamond basically is checking alignment of a company or a potential company with our impact strategy. It has 4 dimensions. They're called transform plus, contribution, and risk. Some of them are self-explanatory, and the others I will try to explain now. So transform is basically a lot based on impact management project tools. It's checking if the activities of the company align with vital impact objectives. So, what are the outcomes and how much impact is achieved and who are the beneficiaries, who are the stakeholders, is it underserved or not, basically based on that. And this is the first dimension of the diamond. Transform Plus is about climate, gender, and jobs. And here again, we're adopting industry tool. If we're looking at gender, it's basically aligned with 2X challenge. Jobs is creating jobs and increasing job quality. And, is the investment aligned with climate agenda, and can we add value there? Contribution is, I think, quite clear. Contribution dimension is basically is the fact that we are investing, making the change. If we would not invest here, would the impact be created anyway? So, your delta as an investor, in some places you invest, and if you weren't there, this impact would not be created. Okay. And in some places, if you wouldn't do it, someone else would. If you're going to a public tender, if you will not do it, someone else would. So your contribution is actually limited. And the last dimension is the impact risk. What is the likelihood that the impact will not happen as you expect? And does it have any consequences on people and planet? Is it negative consequences or assessment of risk? We have also created a visual manifestation of the diamond, so we actually see that, and it's very intuitive. You see if it's full or if it's empty, and which of the dimension is weaker. So you look at the company. It's a lot of work behind that. It's all it's all numerical and it's all data based. It's not we estimate and we discuss. It's all data based, but the formula basically builds the diamond and gets a rating. And visually looking at the company, it gives you a very, very good visual representation of where the impact of this company is strong and where is it not so significant. You see companies where the contribution is fantastic, but the climate, gender, jobs is not outstanding. And you see companies where there's big transformative impact for a large number of underserved communities, but the risk is very high. So this visual tool helps us both in screening, but also in monitoring. In the beginning, it was only for screening. We adopted it according to industry standard, and today we use it when we analyze portfolios. So you will see in our quarterly report, in our report, the investors will see the evolution of the diamond because it changes along the life cycle of investment.
So these four dimensions, I understand that you also have subcategories under each one of those. And I presume that these are rated according to a predefined scale. And so does this then lead to a composite score across these four factors? And sorry to get nerdy here, but do these subcategories have equal weighting? I'm just trying to understand how this works in practice.
That's a very good question. So we've reached to the place where we totally trust the rating per dimension. So we know, and again, we have run our portfolio and a lot of data through this tool in order to see if it gives significant results. So we totally trust today the rating that gives per dimension, and we are testing if the aggregate, as you said, the aggregate rating makes sense. Because I can't say that today giving a 4 for a company or a 3 for a company and comparing contribution to transform makes a lot of sense, and it's very hard. We haven't reached the point where we say, you know what, we know how to rate that. This exactly reflects the reality on each one of them, but we haven't reached the place where we think that an aggregate score gives you, you have, this is 3, this is 5. Now you know what impact is created. We are not there. There's a lot of internal discussion if we should move there, if it will always be biased, if we can actually validate that, if you can compare these dimensions one to the other, and we are not yet there. We are not there into the one aggregated score, which gives you, a full reading of what is the impact.
And does the scoring differ across the different thematics that your fund invests in?
No, the scoring does not differ between the thematics, but naturally between the themes you have things which contribute more to one or the other dimension. So if you deal with healthcare, it's a bit less about climate and maybe, you know what I'm saying. And if you deal with water, it's usually large scale projects. So you have on the how much and who, it's usually very strong. This dimension will be very strong. If I take water, for example, and you serve 2.7 million people underserved first time access to potable water, so your transform would be up to the max, probably. Okay, up to the max. But when you work in when you work in this scale, you usually have to work with governments. So it sometimes will be through public tenders, and it is not always very strong on contribution. So you may say that if you were not doing that, someone else would have. So in water, we see typically a very strong transform element, a less contribution element. Again, depends on the vertical, because within that there's many verticals. But I would say there are typical changes, but there's no different rating between the teams.
So I was just trying to think if this approach if it's challenging to maintain a diversified portfolio. Like, for example, would you be happy to invest in a company with potentially lower scores in a given area, but you see opportunity to improve the scoring through active involvement with guidance?
We have screening definitions where we say no, and our wonderful head of impact and ESG, she says no very, very often. Where we don't believe that this impact would be either achievable or is significant. I would say that we do invest. We always want to invest in the C category, contributing to the solution. But we do opportunistically look at B, benefiting stakeholder. If it's a company that we believe that we can bring it to C. So we are doing that, but we want to see a relatively potentially full diamond. It doesn't say that we start with the full diamond. We want to invest in a company that we think that once we are done with it, the diamond will be full.
Everyone wants to achieve impact and have these nice returns. but it's also sometimes criticized that these calculations and quantifications can only be as good as the data that they're based on. How is the availability of data for this assessment, especially considering the difficult markets that you're operating in? Or do you do all proprietary data gathering and assessment?
That's a great question, and that's at the heart of in the heart of our impact work. Naturally, when there's a very big transformative element, sometimes it's exactly the places where it's hard to get the data. So when you go to rural, faraway places to provide first-time water, it's very hard to get the data there. But I think we are very, very strict on basing it all on data and not on personal or bias assessment. And where we don't have data, we do surveys and we create the data. We either do them by ourselves or we do them through third parties. We just published not long ago our stakeholder survey on a very big irrigation project in India. It was hard work, but it is generating a lot of data that then you can feed into your system, and then you have a baseline, and then you can measure. We would like to do, and we want, and we try to do it before the investment, so we would have a baseline, and then we would do it along, the life cycle of the investment, so we would see the growth and the progress. But sometimes, if you try to invent numbers, it comes out worse than it was without numbers. We're making a lot of efforts not to be there. And when we think that we cannot do a survey, then we will hire someone to do a survey for us. On one hand, it's more challenging for us because of these rural places and remote. On the other hand, remember that we hold either controlling stakes or majority stakes in these companies, and we help seeding or growing most of them. We built most of them. And when we built most of them, we built inside the ESI capacity. So we will have an ESG and impact professional within the company. So it is not only fund level asking the company, among all the other work that they do, to report some stuff and it bothers them. No, it's integrated that the company is also built as an impact investment delivery unit, because this is how we design and build the company, and it's integrated there. And if I'll take, for example, our water platform, which is now operating in 3 continents, before investing in the company, we have built inside the ESG and impact capacity, and it's with, super professional, and it's working independently under the guidance of the fund head of impact and ESG, but they will have the capacity, and for them to execute a survey for irrigation or stakeholder survey in rural India, it's much easier than for us to do that.
Can you pull this all together? We've just gone through a pretty extensive investment process. Can you give me an example or two of a real investment that Vital has made that demonstrates the end-to-end investment process that we've been discussing? And if you can tell me both the financial results and the impact results achieved, just to make this real for listeners.
Yeah, a good example would be our water platform. So we came across an opportunity in the water sector and projects and service. And the first geography was in India, together with a strong group of founders. We know some of them from the past. Again, we're working for 30 years in these markets. They came to us and say, we have this great idea, this great opportunity, but we are 4 people. We're looking for a home. And they're wonderful people, professional experience, but, motivated and strong enough to want to create a change. And we thought it's also a very good mix of local and international experts. So first of all, if I'm going back to the procedure, gate 1, it's water, it's no commercial logging and oil and gas, no exclusion list. Water is within our core team. It's basically aligned with, we can see alignment with SDG. We can imagine in the impact angle. I'm talking about stage 1, right? Just initial thoughts, okay? Water is something that we have a lot of experience from the operator point of view. So me and other people in the team have built by ourselves with hard hats water infrastructure project. So we know the nuts and bolts. We understand that. We understand the real challenges. It is a company which is very operational. They plan it to be a very operational company, so it fits our DNA. And they think that $20 million will get them to where they want to go. So this is more or less, we say, both teams, the impact team and the investment team, look at that. They say yes, it makes sense. Okay, now we go to gate two. We dive in and we find that basically there's a great founding team and all the rest needs to be built. So it's more of a process of building it with them than a due diligence on what is existing. So we do it with them. We build the theoretical diamond of how we think the company would be. So we mentioned water. We see the transform, with the pipeline of projects and investment that they think that they can bring directly once we invest. We analyze that and we see the transform element. We identify that with what they want to do, the contribution element is not high because they want to go only to public tenders. They want to play only in public tenders. And contribution wise, we say, okay, so if we don't win the public tender, another contractor will win. And our contribution as investor is not as high. So we identify that as a point that we need to address, and we ask ourselves if we want to do that. Business-wise, business model-wise, we also identify that EPC or turnkey, being a contractor or developer, it's a limited scope, and we want to make it bigger than that. So this is stage two, and we see that the team is really willing to work with us. So now we dive into gate three, and we really start working with the funds. Okay, again, it's a fantastic team. They're both good people and they have amazing experience. They built the largest water projects that you can imagine. They built it worldwide. They know how to manage. They've been in senior management positions and now they want to do their own thing. And they're burning. They want to do that. So we really love the team and we think they're the right team. We work together, both our impact department and our investment guys. They work with the team together. And we build with them together both the strategy and the theory of change. So we change a bit the growth lens. We think of new verticals which will add, for example, the contribution element, and will diversify the business model from EPC. So we agree together that EPC can be a segue, but let's build a service company. Let's build a company that can hold and develop water assets. We think of technology. What's the use of technology there? Can we add the technological vertical not only in the projects that they execute, but also as a business vertical itself, which is where you come and you have your added value and where you have your actual contribution. So we add this element both from the business model aspect and the impact aspect. They're great guys. When we say impact, they say yes, but they're totally open and they understand that if we are going to build it together, this is embedded, this is integrated in the company. So it's an impact investment company. And so we build with them, we establish the company's, ESI processes. We recruit together a dedicated impact and ESG professional that now will work in the company as a senior manager in the company under the guidance of the funds, ESG and impact. And now we start helping to build the team, wherever they need with the fund network. And sometimes recruitment is a lot of value. So we help in recruitment and this is the initial staging. Now, this company we're working very closely with, very, very closely. It's not a typical fund investee relations. And I would say Vital's typical relations is not with investees is not typical. So, we would work from the project resolution, project execution, status report on a very, very weekly or monthly basis, the pipeline, analyzing the pipeline together, business development, a lot of supporting finance and banking, a lot of supporting in commercial, definitely on the ESG. So there's a lot of constant support that we are basically, I would define it like this, we are working for them. Okay, so we are working for them. We are almost part of the team, we are working for them. Where they feel that we can help, and where there's growth, we are maybe coming back to the fund side. We push growth and we help both bringing opportunities to the table and analyzing opportunities, or helping together with them building the right way to think of how we approach opportunities. So, for example, this company which started in India now is expanding to 3 continents. So, how do we build that correctly? Is it independent units? Is it how is it managed? How will the ESG and impact be managed in such a wide span?
Have you calculated what the impact that you've achieved thus far with that?
This company is implementing the largest rural drinking water in India. 180 million liter per day, if it says anything. It installed 4,500 kilometers of pipeline distribution, and it has 950 villages today which are getting access to water, tens of thousands of hectares of irrigation, and tens of thousands of smallholder farmers getting irrigation for the first time through very good automated systems. This company is providing first time high quality potable water for 2.7 million people. So I think impact is fantastic and it's transformative. We deal with water and irrigation, which is, by the way, both are related to our agri and food experience and our water and infrastructure experience. So the transformation is very evident. And where you give first time access to water, it definitely changes the reality of life of these communities. And the nice thing is that it is in scale. So it's millions of people. We still need to further improve the contribution aspect of impact. We're working with them together on that. And we think we will do it through tech and new services that the company will offer. We're doing a lot of tech POCs, so we're bringing tech that helps with water management and water asset management. We've done tens of POCs, and then the company will deliver them as a service. It's a very promising vertical. Disruptive tech, you can inspect water assets with drones today. By the way, you can inspect the bridge with drone. You don't need to go with the boat and trust on the guy that will roll against the current and will assess if that crack is dangerous or not. So you can do it with drone and basically with AI. And we're bringing all that. The company is doing all that. I'm going there. I'm very excited. I'm going there. I'm going to India and then to visit them in Africa in 2 weeks. I'm very excited to be there. Wherever we go there, as you probably guess, we first dive right in. We first go to the project and we go to the communities and we see with our own eyes and we kick the tires and we're very, very involved ground level. And then we go back to the office and do, I would say, the typical fun work.
And eventually you will exit this business how?
There's a few options. I think you can either get a strategic partner in India, and we have already had some interest in that. So I think strategic partner in India is a very viable option. I think that once we're dealing with water and once we expand, I'm quite sure that funds that are interested in climate will be also looking at this company because it is large scale and it is disruptive.
Maybe I'd like to come at this process from a different perspective and trying to get at what's the minimum criteria you require for an investment. So instead of giving me an example like you just did of investment that you did invest in, can you give me an example of an investment you looked at as a result of this process you went through? You chose not to invest in it because it didn't meet your minimum criteria.
That's very easy. I used to. I'm thinking once in a while, I think that most of what we do is saying no and never materialize. So much of our work is just never sees the light of day. It's very easy. I can give you a few examples. So exclusion list is a very easy example. Someone trying to convince us how commercial logging will help communities and so exclusion list, oil and gas, we're saying no to that. That's a specific example of commercial logging, which the founder thought it will benefit the community. it is within our exclusion list. We don't try to measure that. We say no. I'll give you another example from last week. I met wonderful people in Nairobi. They're doing construction. They're into affordable housing and affordable construction. And they have implemented and built an industrial method to do that, which allows them to do that relatively cheap and efficient. We looked at them, we thought they're wonderful people, great team, and they'll probably be a successful company. But we didn't think that it will get to scale. We didn't think that what they implemented can get to scale. So the number of beneficiaries that can benefit from this company is limited by definition. Water infra projects are always a good case. So we can look at an opportunity, and we looked at opportunities where the project looks good, but the pipeline goes into a unique ecosystem in terms of biodiversity because it saves money. As a real life example, we had discussions there. We actually went to the stage of asking the clients if he would consider bypassing that, and the answer was no. So we didn't proceed. And another maybe day-to-day investment that we say no to is commercial farming. There's a lot of opportunity in commercial farming. We do not claim that it's not good or it's not impactful, but first of all, it does not align with our theory of change in food, which, as I mentioned before, is smallholder farmer. And second, we find that in our markets, a lot of times it competes with the smallholder farmers. That brings me back to the childhood I told you about, my childhood, which commercial farming basically, once it's big, it eats the smallholder farmers. So we don't do that. We will focus on enhancing the smallholder farmers and making them strong players. We do that all day, so much more than we say yes.
We've been talking all this time now about impact assessment before the investment. How does your impact assessment change after an investment has been made, and what are the key KPIs that you track and so forth?
As I said, sometimes we have an unfair advantage because the impact and ESG capacities are embedded into the company, where in the minute that we invest in them, we carefully define and refine how we manage this post-investment over the 14 years that we work. And it's very well defined in our ESIMS. With this post-investment, we're working again within the industry, and we're making sure that our practices of post-investment are industry standard. We are, for example, we talked a lot. We looked at our post-investment with our last verification with the Blue Mark. So we're OPIM subscribers, and we're doing verification with Blue Mark. So that was a very strong focus that we looked at, and it turned out by their verification we are actually outperforming. We excel in doing that, in doing the life cycle, in doing this post-investment intervention. And again, I think here we have this unfair advantage because once you're a controlling stake or majority, and once you build the company or help to build it, it is already there, and you don't have to sell it to persistent, to management. We actively support the development of ESG best practices. We implement throughout the life cycle the corrective action plan that we developed together with the company as a condition to our investment. If you remember, on Gate 3 and Gate 4, we developed with the company, and we signed on in the founding document with the company on the correction action plan. The CEO and the senior management, their evaluation and their compensation is related not only to the financial, but also to implementation of these plans. Okay. And we prepare the investee ESMS. We're doing that. Throughout I would say regular work is the value creation of strengthening the climate, gender, and job strategies of the company itself, even if this is not their focus. Beyond that, we do the normal stuff. I think that every fund like us do, which is the quarterly and annual reporting. We help the investee do that, and we make sure that the impact and ESG reporting is is at high standard. And then we aggregate and we do the portfolio level ESG and impact analysis and lesson learned. We also have the lesson learned very strong in our culture. So we are trying to do post-mortem and see what did we assess, how did the diamond look like when we started, and how does it look like today, and how does it look like when we exit. We still use the diamond throughout the life cycle of, and it helps us a lot.
How have you found impact results to align with or correlate with your portfolio's financial returns? Is there a linear correlation between the number of lives positively touched and the investment's financial return?
I wish I could easily say that they always enhance each other and there's a zero trade-off and the world is beautiful. Sometimes it is. I would first say that we choose to work and to invest in places where we believe that they can enhance each other. So we choose to invest in things that can showcase what impact investment is. There would be less conflict. Usually we find that definitely in the extremes, they're correlated. There's very strong correlation. By forces of nature or by forces of business or I don't know by what, where things go well, we find that both impact goes well and meet their KPIs and financial meet their KPIs. And when thing goes wrong, we find that both of them are struggling. Sometimes in the middle, it can be confusing, but I think if you wait enough time or if it gets to extreme, it's very, very clear that there's very high correlation. The clearest example is that when a company goes bust financially, then you have zero impact, right? Sometimes negative impact. So in the extreme point, full correlation, high success, full correlation, failure, full correlation. And within the life cycle, I think when it's mature enough, there's relatively high correlation between them.
So you feel definitively you don't sacrifice financial returns to achieve impact?
Not at all. I don't think we're doing that at all. Having said that, we are choosing investments that will allow us to showcase this. We're not claiming that this is how the world works. You know what I'm saying? I'm not saying that any investment that I would do tomorrow, I would not need to sacrifice either impact or financial return. I say that the investment that we choose to do, we do not need to sacrifice one for the sake of the other.
Vital Capital's approach to risk has been described as unique and something which has opened up opportunities for investment in what you have described as previously overlooked opportunities. So Nimrod, for $64 million, what does this mean in practice? Why is it unique? What is an overlooked opportunity that you refer to?
We are operators. Remember where we came from. We did not start as investors, right? We did not evolve. We evolved to be investors. We are operators. We have done this before. We can grab the wheel if things go south, the actual wheel of the company, and we have skin in the game. We do that and we build things from zero. So let's say you have a building that was originally planned to be a hospital and is not working from the 1,000 reasons that you have white elephants in these places. It's not working. It's not done. And it's not producing nothing to anyone. No business and no impact. Okay. Can I take this asset, make it a medical center? I will look at that as an investment. Now, construction, we've been there, we've done that, we've lifted MRIs to the 8th floor before. We know exactly how to do construction cost effectively. We know exactly how much it will cost, what are the risks, and how to manage them. Equipment, we've done that before as operators. So the execution risk is minimal. Operation of healthcare facility, we have done that before. We've done that before we've even dreamt of being investors. We know how to do that. Now, once it starts, so we can take it, we can build it, we can equip it, and then we can operate that. Through the operation, can we now improve the business? Can we make sure that it addresses the right clients that are both, that can pay for that? Okay, let's aim and find the right paying segment. Let's bring the guys with health insurance and work with the insurance companies to include our facility as their, as their favorite. We know how to do that because we have again, grown in this business environment, and in the end, bring that to a successful business, which you can exit. Are all these stages aggregated big risk? If you look at it from the outside, yes, it's huge risk. It's not a PE play. For me, for us, it's not a big risk because all the first steps are things that we've done and we control and we know how to do. The commercial thing, yes, this is always a risk, but we've been involved in creating so much values in this environment that we believe and we feel that we know how to do. So the story I just told you, now click on our investment called Luanda Medical Center, and this is the story. What I'm trying to illustrate is that in some places there are opportunities that no PE will touch because it's not the typical PE work. I wouldn't go as a minority investor into someone else having this program. Then I wouldn't be a 5% or 10% or 15% there. And when someone else is in charge of execution, implementation, operation, and all that, just because he pitched me well. But when I know that, I know how to execute it. And we bring the management and we build the company to do that. I think the actual risk for us is minimal. And since we build the value from zero, it's not you negotiated growth with an existing profitable company. Since the value is zero for everyone involved, it's a sunk cost basically for them. Then once it's operating and profitable, you can create a successful exit.
You highlight the importance of on-the-ground expertise to execute on your strategy. How do you find the right people to partner with?
Right people and partners are gold. Once you find them, you never let them go, And even if you've done something together and then each one was in his own, taking his own path, we keep our network close. This network of our coalition of operating partners, people that we worked with and done things with before we became investors, and during the last 14 years. And they're spread and they're doing many different things, but most of them are within our teams. Now, these guys, most of them are good friends, and we've been through the good times and bad times together in project execution. These guys are very helpful in identifying and originating opportunities. As I told you before, I gave the example, I gave you before the example of the water opportunity. And we have many opportunities coming from these guys and their network. This on-the-ground coalition is what Vital actually evolved from. So I wouldn't say it's a capacity that we have built. I would say that this was the original capacity that we have built Vital on. So we are operators, and we have built a very strong investment capacity and a very strong ESG and impact capacity. So we actually, in the first day, we recruited we headhunted people from other funds, from BFIs, because we needed to learn how to ESG and impact in a professional way, and we have needed to learn how to do fund governance in a professional way. But the basic thing we have, or what we grew from, is the operational capacity.
I'm trying to get at, do you look for local people or more like people with knowledge of the region?
Partners, you always have to have local partners. And it differs. Some professionals, for example, some water professionals we will bring international management. We might, depend on the region, we might bring and grow local capacity. Sometimes we create joint teams. This is the best, for us. But it will always be a mix, and main partners will always be local.
Since you do a lot of greenfield projects, getting the trust of local governments for what you're doing is essential. How do you go about engaging them to meet targets and getting them on board?
Yeah, you're totally correct, Scott. When you want to reach many people and you want to work outscale in these places, you will be engaging with government. Somehow you will be engaging with government. I understand that when a startup says, or I'm not dealing at all with government. I'm only B2C, whatever. Fine. But I think if we're dealing with our themes and you want to get to scale, you will work with government. So first, we have a lot of experience in doing that, and I think it's a lot about building trust. My wife say, first you dance their dance. So you don't come with your own dance and try to show them. First you dance their dance. And now you create natural alignment. And I think we do have natural alignment when you do impact investment, when you provide basic goods and services, and when you're aiming to, to lower a socioeconomic segment, and it's about jobs and affordability and accessibility. I think that the natural alignment is there, and the discussion is many times is to help the government see how you help them achieve their goal. So many of these governments will have their 5-year plan, and understanding how you help them achieve their 5-year plan, even without them needing to allocate any budget for them. So the discussion starts from a good alignment. And the last thing, which is very convincing, is skin in the game. When you come with private investment, skin in the game, this eases the conversation, because many of these governments are used to hold the beautiful story and then the punchline of, okay, how much money can you give us? Our punchline is not that. So I think there's basic alignment, and I think there's so much cultural and work experience that we come with. We find this conversation usually very constructive.
Vital capital is extremely highly regarded for the approach that we've been discussing today. What makes Vital Capital different from its impact peers, and what is the USP that's really the key to your success?
It's that we are super operational by DNA and experience. So many of the impact investment peers would be stronger in other points and have other advantages. I think our advantage is there. We are very experienced investors by now, and we are very experienced impact and ESG practitioner by now. But our strong core and our DNA is operational. We don't see ourselves as managing money. We actually don't see ourselves as managing investment. We're building and managing companies according to investment models we have learned and improved along the way. So this is what we do. I think Vital, for me, is I've never met extreme accountability as there is in Vital. I think it's because of the operational DNA. I don't think the investment team ever said the word macro, geopolitical, exogenic, this happened, this is a black swan, maybe in COVID, okay? But apart from that, it's all us. Now, because we have majority stakes and because we build with the founders the company, it's our responsibility. If it works well, it's because of us, or partially because of us. And if it doesn't work well, it's because of us. I'll give you an example. An investment team member, there was a management issue, something was not managed carefully, and some money was in risk. So an investment manager saying, I want to fill that in with my private money. Okay, so this is, I want to put in the money that if this money is in risk, if we lose this money, I want to put my own, I'm going to transfer from my own European bank account to the portfolio company to make up, because it's my responsibility. It's not that it happened, by the way, and not that we would have let him do that, but that comes to show you the different level of accountability. And again, I think it is because of who we are, but also because of how we structure and how we invest and how involved we are in the companies and in the company's life. So that allows extreme ownership and accountability. The last thing I would say is that we are deep within the impact industry, as you noticed, and we're trying to be vocal and be in the leading line, but in the same time, we have a strong focus on returns. And it's not by chance. We want to be high achieving, and we want to show good returns to our investors.
Looking forward, where do you see the biggest opportunity to replicate the investment model that you have developed in Sub-Saharan Africa?
Replication is definitely part of the core business strategy as a fund. We call it build and rebuild, and some people say it's build and repeat, build and replicate. We take the same model, we do it here and there and there. Sometimes it's work, definitely when it's the basic concept and approach work, but the details and the strategy have to be tailored to local reality. Even the examples that we discuss with smallholder farmers. You take one very successful model from West Africa to East Africa, and if you try to only to copy it, it will not work. You have to change it because here the farmers actually produce very well. What they need is access to market and off-taker, someone to add value to the fund. And on the other hand, there's great growing condition, but they have to have enhancement in productivity, etc., etc. But the market is relatively easy once you have the product. So there's a lot of adjustment according to the market. I think that in India and in Latin America, there's a lot of models that we can replicate, but after a very, very strong adjustment. So the model, the concept, and the focus can work, but not to mistake and think that the market is the same. What I want to do is to take companies across borders. So to take a company that did well in Peru and knows how to manage wastewater facilities, and then bring it to Angola, to Ghana, and to Uganda and create wastewater facilities. So here it was for municipal, here it is for industrial players, but the company already knows what it's doing. And now you help them scale and you help them expand. That's, again, an example, a real life example that they just gave. So you take one very strong thing that the company knows, and then you help them build, according to the new market, all the other capacity.
Nimrod, I've got a few last rapid fire questions to wrap up our talk here. So just give me whatever comes to your mind, or if nothing does, feel free to take a pass. But if you had to name the one most important challenge in the private equity impact investing space at this time, what would it be?
The most important where we are now is to prove that impact investment is a good investment alternative for your money. The most important thing is to attract a broader pool of capital. And the way I think we should all do it is by showing that it's a very good investment alternative.
In other words, it's not only good in terms of affecting lives, but equally good in terms of financial return to your portfolio.
Even if you're not totally impact orientated, and if you didn't look for it, if you see that, then it can be presented as a viable and good investment, because you will make the same money, or maybe you will make more money than putting it in an index or in any other investment alternative. And additionally, you are also contributing to the impact. I think then we will be able to address and really make impact investment a very big industry. As long as we will address the same people and the pools of capital will be the same, even if we'll do great work, it will be hard to grow the industry and make it really big and really scalable.
What do you know now about private equity impact investing that you wish you had known in 2011 when you landed at Cora?
I've gone through my Dunning-Kruger ride, thinking very quickly that I know what impact investment is, and then finding out that I actually really don't know, and it's really deep, and you really need to be professional, going through the death valley of thinking that I don't know anything, and I hope that I'm today somewhere here in the climbing and gaining more knowledge and understanding more and more as it goes after 14 years of being involved here. I think the most surprising, counterintuitive, not necessarily great thing is that I think I know today that to call yourself an impact investor is sometimes a double-edged sword.
In front of investors, or
yeah, for example, in front of investor. So when you talk to new investors or to new partners and you say, we are impact investors, that sometimes you're done. You're
You
done.
never get to that.
You're never done. Even if you'll say, and we make 30% IRR, they will never hear you. So sometimes it's a double-edged sword because unfortunately, impact investment is sometimes received as this risky thing or this, good doers. They're not interested in, and there is this wide spectrum. So maybe maybe clarifying the definitions of where each one plays. I would say that would be a very positive thing for the industry because is it impact first? Is it almost philanthropy? Is it returns first? Yeah, but I certainly know so much that I haven't known there, and it's funny because every serious partner, every senior recruitment that we do, I watch them go through the Dunning Kruger of they think they know what the impact investment is. They read a few things, they know what it is, and then going through the process of really understanding what it is.
You don't have to name names, but can you describe to me an investment you made that you were convinced at the time you invested that it ticked all of your impact boxes, but in the end it didn't turn out? And what was the lesson learned from that experience?
It's actually, I have a company that ticked too well and it was a poster child of impact investment. It was early days for us, and it was too good to be true, and the company went bust. And what is the lesson learned? When the company goes bust, you have zero impact and sometimes negative impact. And the lesson I would say, there is no impact model without a business model. When you're dealing with impact investment, they have to go together.
Investing in a business that's not financially sustainable is not sustainable investing, no matter what they're doing.
This is exactly the example of that. It is great. You can show the impact momentarily. It makes impact, but in the end game, it's negative impact, and it's definitely not sustainable. It has to be financially sustainable.
And now the converse of that, can you describe an investment that you had some level of skepticism, either at the time you invested or maybe you ultimately passed on it, and in the end, it turned out way better than you thought and you were pleased you invested, or if you had passed on it, you wish you hadn't? And what was the lesson learned from that experience?
I don't really do regrets. I don't that, and because I believe that what you know today and how things went is not how you should judge your decisions. Your decision, you should judge them according to the information you could have had at the moment of taking them. This is how I look at past things that we missed or we've done and they didn't succeed. And this is how I analyze. At the time of decision, did we take it? Could we gather more information? And was the decision right according to the information we gathered and or we could have gathered? But I won't tell you I didn't do that. And it was maybe we assessed the risk and the risk did not materialize. But I don't feel that I missed that. As a practical example, I'll give you where I was a bit skeptical, and we worked through that. Go back to the example of our water platform that we talked a lot about. So I was a bit skeptical about the contribution that we can make with this company, because the main core idea was let's do public tenders. And I was a bit skeptical if we can actually build this contribution into the company. And I'm really happy to say that with hard work with the founders, together with the founders, we have managed to build it, and we're still building that. In the beginning, I was not sure that we'll be able to do that, but again, the founders were so open, and the impact and ESG capacity was so embedded in the company from the moment of inception that we all went and we were all aligned on the fact that we needed to build together this dimension.
But what was the lesson learned from that? Because you were skeptical when you went in.
Here, the lesson learned is that if there's full alignment between the fund and the investee, you can reach whatever you want. I mean, you can build and grow a new business model and an impact model, even if they were not very clear from the start. So the lesson learned for me here is that the strong alignment with the founding team allowed this. And I think if we had some less alignment, I think if their interests were a bit separate or conflicting with the fund, that would be definitely the last thing that we would all approach.
And if someone wants to get into the private equity impact investing space, especially in the emerging markets, where would you advise them to start?
I think there are many ways to reach impact investment. I mean, you can come to it through investing, through operation, through the impact, through the financials. I think if you are focused on impact and this is what you want to do, I would say you have to make sure you do some business training as well. So you understand business as well. I found that you have to be very accurate when you raise the red flags as an impact professional. You have to reduce your false positives and your false negatives and to focus on what is doable and what is not doable. So as an impact investment professional, you have to find the solution, not only to raise flags, because obstacles and things that cannot be done are very easy to identify. Our head of impact she, for example, comes from the impact and she's an impact and ESG professional, but she comes with a very practical approach of solutions and plans. So if you don't understand what the business is, you will be much less creative on building the impact solutions to fit the business. So I would say if you want to, you can, of course, come as operator like me and then learn how to do impact investment. You can come from the investment side and then you have to go through the Dunning-Kruger, learn what is impact. And if you come from the impact side and your focus is to be an impact professional, I think you must learn what is business and how this is done. Go through business training and try to think business.
Nimrod, you have been very generous with your time today. I've really enjoyed it. It was good talking to you. The way things have panned out in my career, I've really not worked very much in Africa. It was always there, but I never really got to sink my teeth into it. So I've learned a lot, and I think you have given a lot of people an awful lot to think about that and to think about Africa considering the future. So thanks for coming on. Tell everyone about your websites and your social media and all that good stuff.
Thank you very much, Scott, for having me. It has been a very, very interesting conversation. And I think questions were right on spot. I'm a listener to your podcast. Even though it is sometimes so far away from my impact investing ecosystem, I listen and I learn a lot from the people that you bring. So thank you very much for that. And I think even though things cannot be imported as is, we definitely have a lot to learn from impact investors and from the voices that you bring that do different things in different geographies and different investment ecosystem. So that's great. And I hope to listen to so many more of your episodes about Vital. Just, Vital Capital on Google or on LinkedIn. It's quite easy to find us.
So it's Vital Capital, VITAL Capital.
Yes. Capital.
Is it vitalcapital.com?
Yes, it is vitalcapital.com.
Yeah. Okay. Perfect. And on LinkedIn?
Website and LinkedIn.
And what's the best way for people to contact you?
The website has both info mail and invest mail, so people can definitely use that. And we try on our website to explain well what we're doing and what is relevant for us. People can always approach us through the info mail or invest mail. I would say for potential partners or strategic moves, I'm always happy to talk and listen. It's easy to find me in LinkedIn as well, Nimrod Gerber. I'm happy to talk with anyone that thinks that we can do something interesting together or to help and direct to my network, either in our team or to my network where things are less relevant or less fit Vital mandate. But definitely happy and curious to know of good partnerships and good impact investment opportunities.
Okay, Nimrod, thanks again. Bye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.